Welcome to the deep dive. Today we're cutting through the chaos of financial markets. You know, that messy, noisy world that often leaves us feeling more confused than empowered.
Hmm.
Our mission for this deep dive is pretty clear. We really want to unpack why focusing on the rock-solid underlying fundamentals of a business, rather than getting caught up in the daily headlines and all that market noise, truly leads to smarter investing decisions for you.
Yeah, and we'll be drawing on some powerful, timeless insights from two absolute titans of the investment world. John C. Bogle, the founder of Vanguard, and the legendary Benjamin Graham, often called the father of value investing.
Right.
Their wisdom, honestly, it couldn't be more relevant today.
Absolutely. Because here's the core problem, isn't it? The market, for so many people, it's just this swirling vortex of daily ups and downs, expert predictions that seem to contradict each other constantly. And these hot new trends that pop up and then poof, they vanish overnight. But what if all that frantic, attention-grabbing noise is actually just a massive distraction,
Yeah.
pulling you away from what really matters for building long-term wealth?
That's the key question.
Okay, let's unpack this a bit. The stock market's real rate of return, it's been remarkably steady over very long periods, right? But year to year, wow, it can be incredibly varied.
It really can.
Think about it. Back in the 1800s, returns swung pretty wildly, like 16.9% standard deviation, up or down from the average each year.
Hmm.
Fast forward to the modern era, and that typical swing, what statisticians call standard deviation, it's actually jumped up to 20.4%. It feels like the market's just gotten bumpier.
Has. And this volatility you're describing, it's not just a market quirk, right? It directly triggers what Bogle famously called consistently counterproductive investment patterns among us investors.
So-
Well, it forces us into a short-term trap. We see fund shareholders' typical holding periods have just plummeted. If you look back to the 1960s and 70s, the average holding period was, what, around 12.5 years?
Yeah, sounds about right.
Today. It's down to about 3.25 years. And annual turnover rates are running at a staggering 31%. People are just jumping in and out constantly.
And it's not just individual investors caught in this whirlwind, is it? Even the pros, the mutual fund managers, often get swept up.
Oh, absolutely.
Their average portfolio turnover back in 1997 was a shocking 85%. I mean, that means they were holding stocks for only slightly over a year.
Right. It sounds less like long-term investing and more like, well, short-term speculators, as Bogle put it.
Exactly.
And, Columbia law professor Louis Lowenstein observed this too. He said mutual fund managers exhibit a persistent emphasis on momentary stock prices. This constant churn, this chasing of short-term signals, it generates costs,
Huge cost.
but often, sadly, not better returns.
Remember the January effect? That whole idea that small stocks would magically produce big gains early in the year.
Oh, yeah, that was everywhere for a while.
Everyone was talking about it, predicting it, but then it just kind of withered away.
Yeah.
Classic example of market noise and a forecast that just didn't hold up.
And the profound insight here, it really comes from Benjamin Graham. He saw how we often treat stocks like lottery tickets, chasing hot tips and fleeting headlines. But his core message was revolutionary. A stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price.
Such a fundamental point. It's about the business itself.
Exactly. And connecting this to the bigger picture, Graham famously described the market as a pendulum that forever swings between unsustainable optimism and unjustified pessimism.
Love that analogy.
And the intelligent investor, he advised, sells to optimists and buys from pessimists. So don't get caught in that emotional swing. He even said, never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. Avoid the extremes.
Which is why people like David Swenson at Yale would literally tell you, ignore Jim Cramer, pay attention to Jack Bogle.
Right.
Cramer's whole show, entertaining as it might be, is about riding those momentary price swings. Bogle was always about the long game, ignoring the noise, focusing on that underlying business.
And Graham also warned against what he called new era investment. He saw it emphasizing, changes of the future instead of the facts of the past.
So hype over history.
Pretty much. And this led, he said, to the incredibly absurd notion that a stock's desirability was entirely independent of its price. Just buy it, no matter how high.
We definitely saw that play out, didn't we? The new economy tech bubble in the late 90s.
Exactly. Which ultimately led to a 50% market crash. And then we saw it again, another speculative frenzy in 2007, 2009, that resulted in a 57% stock price decline. These were periods driven by exactly what Graham warned against: speculation based on hype, not solid fundamentals.
Let's make this concrete. Think about Cisco versus Cisco back in the early 2000s. Cisco Systems, the tech darling everyone was buzzing about,
High flyer.
had a market value of $222 billion. But its net earnings, only $2.7 billion.
Okay.
Meanwhile, Cisco Corp, this kind of boring food supply company,
Steady Eddie.
right, publicly traded for 30 years, had $17.7 billion in revenues, $446 million in net income. But its market value was only $11.7 billion.
Wow. That's a stark difference.
Huge disconnect, right? The market's excitement for Cisco was completely detached from Cisco's clearly stronger underlying business fundamentals.
Yeah.
It really shows how price can just float away from actual value.
A perfect illustration.
So we've talked about the loud, distracting noise in the market. But what if there's an even more insidious force, like a silent drain on your wealth, that's just as damaging, maybe even more so?
Now you're getting to Bogle's core message.
Yes. Yeah. This is where his seemingly simple mantra becomes truly profound. John Bogle repeatedly emphasized this simple yet powerful truth that just gets lost in the market clamor. Cost matters. He wasn't kidding.
No, he absolutely wasn't. And it's so easy for investors to dismiss, a percentage point or so in fees. We think, oh, it's just a tiny bit.
Right, what's 1%?
Exactly. But the impact over time, it's staggering. Look at equity funds. The lowest cost ones average maybe 0.2% expense ratios. The average fund, 1.5%. And the highest core pile is way up at 2.2%.
And that's just what they tell you, right? The advertised expense ratio.
Precisely. Beyond those stated expenses, there are hidden costs, like portfolio transaction costs. With average fund turnover around 80% annually, remember that short-term speculation we talked about? Well, that churn can easily add another 0.5% to 1.0%, maybe even more, to your total costs. Jack Bogle's son, John C. Bogle Jr., actually did studies showing trading costs as high as 1.8% for small growth stocks. It's a truly silent drain.
So, okay, let's add that up. You combine the visible expenses with those hidden transaction costs, what Bogle called the aggregate fiscal drag. It can swallow more than 3% of your money every single year.
It's huge.
Imagine earning 10% on your investments, only to find 3% of that, nearly a third, is just silently siphoned away before it ever helps you. That's a massive bite out of your potential wealth, and you might not even realize it's happening.
And it doesn't stop there, does it? This brings up the whole tax efficiency issue, too.
Ah, yes, taxes.
Because actively managed funds, with all that buying and selling, that high turnover, they're frequently realizing profits or capital gains. And when they realize those gains, they typically have to distribute them to you, the shareholder, which means you get a tax bill every year, even if you haven't sold a single share yourself.
That seems crazy.
It is. A 12% pre-tax return could easily turn into maybe an 8.5% after-tax return for a typical equity fund. You're just needlessly sacrificing 30% of your gain to taxes. Bogle himself called the tax issue the black sheep of the mutual fund industry, and for very good reason.
Wow. So this all boils down to the tyranny of compounding costs, doesn't it? Those seemingly small differences, especially when it's cost compounding against you, lead to these just staggering differences in how much money you end up with.
Absolutely. It's like that tiny leak in a bucket analogy. Seems insignificant at first, but leave it for years and the bucket's nearly empty.
Yeah.
Bogle illustrated this so vividly. Imagine you invest $10,000 and hold it for 40 years. Let's say the market gives you a 12% return. Pre-tax, pre-cost, that $10K grows to $931,000. Pretty good, right?
Amazing.
But factor in the typical costs and taxes of an average mutual fund, bringing your net return down to maybe 8%. That same $10,000 investment, it only grows to $217,200.
Whoa, that's less than a quarter of the potential.
Just 23% of the projected capital. The difference is monumental, and it's almost entirely because those costs compound against you year after year after year.
And what's fueling some of these costs? It really feels like we're seeing this brand war on Wall Street, where firms seem more focused on getting the right product in front of the right audience than on actual investment management skill.
You've hit on a really key point there. Since 1980, these things called 12b-1 fees, which are basically marketing costs paid by shareholders, by you, have grown from basically nothing to over $6 billion annually. They average about 0.40% of assets for funds that charge them.
So I'm paying for them to advertise.
Essentially, yes. And what's even more concerning is that fund advisors can actually increase their advisory fees and then spend that extra money on marketing, all without needing direct shareholder approval for those specific marketing costs.
That doesn't seem right.
It really highlights how the interests of the management companies often take precedence over the interests of their shareholders. They're spending your money to attract more money, which benefits them, not necessarily to improve your actual investment returns.
Okay, this is all pretty sobering. Costs are huge, taxes hurt. But what about performance?
Yeah.
If I'm the average investor and I see a fund manager with an incredible 10-year track record, beating the market year after year,
Yeah.
isn't it just logical to put my money there? Surely past performance has to mean something for the future, right?
The siren song of past performance. It feels intuitive, doesn't it?
Completely. We're hardwired to think if someone's a star, they'll stay a star. Like, how do we fight that deeply ingrained psychological urge when the evidence seems to say the opposite?
Well, it's crucial to understand this, and it's maybe the hardest pill to swallow. Despite what feels right, there remains no evidence, none, that superior past performance is predictive of future success.
None. Really?
None that holds up statistically. This is largely because of a powerful pattern in financial markets called reversion to the mean, or RTM.
Reversion to the mean, like things eventually go back to average.
Exactly. Think of a basketball player who hits an incredible hot streak. They might be great, but it's statistically unlikely they'll maintain that exact same peak performance forever. Their shooting percentage will probably drift back closer to their long-term average. Markets and fund managers work much the same way.
So even the absolute best aren't immune to this.
Not at all. Look at Legg Mason Value Trust. It outpaced the S&P 500 for an unbelievable 15 consecutive years, from 91 to 2005. Sounds like a sure bet, right?
Definitely sounds like a star.
But then, from 2006 to 2008, it fell behind the index by an astonishing 43 percentage points. Ouch.
Wow. Okay.
Bogle even studied this by looking at fund performance by quartiles over decades. He found, in truly incredible symmetry, the first shall be last and the last shall be first. Top funds from one decade consistently move down to average or even bottom quartile performance in the next.
So the winners become losers and vice versa.
Very often, yes. It's that reversion to the mean in action. Even Morningstar, famous for its star ratings, their own editors candidly acknowledge their star ratings have little predictive value.
They admit it.
They do. And the Halbert Financial Digest tested a strategy of buying five-star funds as they emerge and selling when they lose the rating. The result? Below market returns at above market risk. The evidence is just overwhelming. Chasing past winners doesn't work.
Okay. All of this makes you wonder then, what is the secret? Because Bogle put it so perfectly. The secret of investing is, finally, that there is no secret. It seems like it has to be about ignoring all this noise and just embracing common sense.
That's exactly it. If we connect this to the bigger picture, Bogle's advice is simple, almost deceptively so. Follow a simple plan and let the cycles of the market take their course. Don't try to outsmart it.
So what are those core principles?
He laid them out clearly, all focused on fundamentals, not noise. First, invest you must. Sitting on sidelines is the biggest risk. Second, time is your friend. Give yourself all the time you can, he stressed. Begin to invest in your 20s, even if it's only a small amount, and never stop.
Start early, stay invested.
Precisely. He constantly reminded us compound interest is a miracle. But the flip side is crucial. Impulse is your enemy. Eliminate emotion from your investment program. Don't panic sell, don't chase fads.
Easier said than done sometimes. So how do you practically focus on those fundamentals rather than getting sucked into the market's daily drama? What actually drives those long-term returns Bogle talked about?
Right. Over the very long run, Bogle explained, stock returns are and must be driven by, well, business returns. What he called fundamental returns.
Okay, business returns. What does that mean?
It really boils down to two things. First, the initial dividend yield you get when you buy the stock. And second, the subsequent rate of earnings growth of the underlying company. That's it.
Dividends plus earnings growth.
That's the engine. And what's truly striking is that when stock market returns get far ahead of fundamental returns, which usually happens during periods of, excessive optimism and speculation.
Like the bubbles we talked about.
Exactly. When that happens, Bogle said, it is only a matter of time until the market return reverts back towards those underlying fundamentals. The market price might dance all over the place day to day, but it's the business's actual value and growth that ultimately determine your long-term wealth.
So if picking individual winning funds is so hard, maybe impossible consistently, and costs are such a huge drag, what's the alternative for the average investor who just wants to focus on those fundamentals and tune out the noise?
Well, this leads directly to the elegant, powerful solution that Bogle championed his entire career. Sensible investors avoid the active management morass, embrace the certainty of indexing.
Indexing, buying the whole market, essentially.
Pretty much. The fundamental theory is simple but profound. All investors, as a group, cannot possibly outpace the total cost-free return on the entire stock market. Think about it. For every active investor who beats the market, someone else has to underperform it. It's a zero-sum game before costs.
And costs make it a negative-sum game.
Precisely. So an index fund simply buys and holds a broad basket of stocks like the entire U.S. stock market or the S&P 500, aiming to match the market's return, very cheaply, not beat it.
And does it work? How's the performance?
The performance truly speaks for itself. A total stock market index fund, for example, has outpaced the average diversified equity fund by 2.5 percentage points per year over 15 years.
2.5% per year, that's huge compounding.
It's massive. That index fund captured 99% of the annual market return, while the average active fund lagged significantly. That 2.5% difference translates to an added return of more than $23,500 on just a $10,000 initial investment over that 15-year period.
Wow. That's real money, just from keeping costs low and capturing the market return.
And there's more. Index funds are inherently tax efficient because they have very low turnover. They're not constantly buying and selling like active funds. So you avoid those unnecessary capital gains distributions we discussed.
Right. Less tax drag, too.
And they bear substantially lower risks than actively managed funds. Morningstar data showed index funds were 30% less risky over 5 years and 16% less risky over 10 years compared to active funds. It really embodies that focus on fundamentals. Buy the market, hold it patiently, keep costs minimal, and let the underlying businesses do the long-term work for you.
And it's not just Bogle preaching this gospel, is it? Other legendary investors agree.
Oh, absolutely. Even Peter Lynch, the legendary manager of the Magellan Fund, said most investors would be better off in an index fund. Charles Schwab stated, only about 1 out of every 4 equity funds outperforms the stock market. That's why I'm a firm believer in the power of indexing.
Even the Motley Fool guys advise, we don't think there's any other fund out there worth buying.
Right. The creation of Vanguard itself was rooted in Bogle's vision for funds to be operated in the most economical, most efficient, and most honest way possible. Indexing really is, as Bogle put it, the triumph of experience over hope, because it's based on the cold, hard reality of market returns and costs, not on the fleeting hope of finding the next superstar manager.
Okay, so stocks, especially broad market index funds, seem like the core engine for long-term growth, focusing on those business fundamentals. But what about bonds? How do they fit into this ignore the noise philosophy? They don't offer the same growth potential.
That's a crucial point for managing the overall journey, managing risk. While stocks are the growth engine, bonds are the shock absorbers. A wise starting point for most investors, as Bogle suggested, is the basic principle of reducing your equity portion as you age and increasing commensurately your bond portion.
So dialing down risk as you get closer to needing the money.
Exactly. Bonds play that crucial role in moderating that risk. We saw this clearly during the 2007-2009 stock market crash. While stocks plummeted, high-quality bonds actually provided positive returns, cushioning the blow.
Right, they zigged when stocks zagged.
Precisely. So asset allocation, how you split your money between stocks and bonds based on your age, goals, and risk tolerance, is a reasoned, if imperfect, approach to the inevitable uncertainty of the financial markets. It's another key way to manage the noise, not by trying to predict it, but by building a portfolio that can winter it.
Okay, so to wrap up our deep dive today, wow, we've covered a lot. We've seen how that seductive noise, the market's daily swings, the endless predictions, the hype combined with the silent drain of high costs, and that persistent myth of the star performer can truly derail even the most well-intentioned investor.
It's a powerful combination working against you.
But the combined wisdom from these giants, John Bogle and Benjamin Graham, it points to a really clear common sense path, doesn't it? Ignore the noise.
Right.
Focus relentlessly on the underlying fundamentals of the businesses you own. Embrace simplicity, minimize those insidious costs, and commit to a long-term strategy, especially through the power of low-cost indexing.
That really is the essence of it. And it raises, I think, an important question for you, our listener. Bogle once noted, somewhat pessimistically perhaps, that if this industry ever had a chance to produce another Peter Lynch or perhaps the next Warren Buffett, that chance is disappearing fast.
Why did he say that? Because indexing makes it harder to stand out.
Partly, and because the focus shifted so much to marketing and asset gathering rather than pure investment skill, perhaps. So, in a world where the financial industry often seems to prioritize its own profits over your returns, what does it truly mean for you, the individual investor, to really take control of your financial destiny by choosing this path of simplicity and fundamentals?
That's the final thought to chew on. What will you do differently, starting today, to actively resist the allure of all that noise and focus steadfastly on what truly matters for your long-term financial well-being?